we're back. Um, Again, trying to break these videos up, keep them short, uh, because I know we're all busy. But anyway, so I still have a UPro up here. I'm going to type in. So this is TQQQ. So this is another ETF. You can see it right there, TQQQ. This one is similar to UPro. The only difference is the daily holdings for this one is, so this is the NASDAQ, which is, this is like the best stocks in the US stock market. And this is actually the top 100 companies. So you see it's a little bit less than UPro. There's less companies, but it's basically taking the top 100 companies in the US. So you still have your top three: Apple, Microsoft, Amazon. Top four: Alphabet. You see Tesla is there, Nvidia, Adobe. A lot of tech companies are in this because tech has been really big for the last few years. So again, you can always go to Google, type in the symbol, in this case TQQQ, daily holdings, and you can see their top holdings, what companies they're holding. So I'm not going to go into too much detail about that. We still have our settings for our chart, 6-month chart. Still have all of our settings. You guys can see where it's at right now. Over the last few days, climbed quite a bit, but it's at $157.71. Okay. Coronavirus. Here was the dip, right? You can see it did pretty much the same thing as UPro. Kind of gave this little false breakout here and then continued down. But again, it's easy to see the downtrend, right? We started this downtrend, it continued, then it levels out and starts pulling back up. Okay. I will tell you guys, so I just want to show you this. We go to TQQ 10-year return. So this is something I want to show you guys. Morningstar, right here, www.morningstar.com. It's a good tool to see stocks or ETFs, their long-term return. So you're going to go to that, then you're going to, I think it's already on performance, but if it's not, just click the performance so you can actually see. And I don't know why this is going so slow. Not digging this new internet company very much. All right. So I've showed this to a couple of, some of the guys that work with me. But this is going back to 2010, 2011. So you can see this is the growth of $10,000, right? When you look at this, you can see it was slowly growing, and then tech companies since 2016 is really kicked off. So it's pretty crazy when you think about it. To think, 9 or 10 years ago, if I invested $10,000 and where I'm at now, where it's at now, I could potentially be, a millionaire starting with $10,000. It's pretty crazy. no other stock. Granted, like Apple, Tesla, they've made some big moves over the last few years. Netflix, but you're talking about one company, right? So one company, and if something goes bad with that company, um, you stand the chance of losing a lot of money. Versus this is all the big names: Facebook, Amazon, all your big names. So let's say, for example, Facebook goes out of business, um, and Facebook stock just crashes. It's not gonna affect this that much because your money is spread out across Amazon, Microsoft, all these different companies. So one company going bankrupt it's not going to kill you. I always tell people, don't put all your eggs in one basket, right? So you have $10,000. You don't want to put your whole $10,000 in one company because if something bad happens and that company goes out of business, there's your life savings is gone, right? Versus this, you're spread out. It's instant diversification. So anyway, I just wanted to show you this because it's important to point out there's no magic formula or anything like that. But to think about this, if this is like the easiest thing. Back here, in 2012, 2013, I buy this on a dip. I buy $10,000 worth of stock and I just forget about it, and I just sat on it. It's really boring, right? Oh, I'm making money 2014, 2015. I just wait. It continues up. There's not many stocks you could say over a 10-year period that I turned $10,000 into 500,000, right here. And now where it's at now, it's almost $1 million. That's crazy. I mean, to me, it's the easiest. It's as easy as it gets. And this is one reason I've started following this ETF is because the potential gains are huge in a short amount of time. And if you look over here, you can actually see, the price over the years. And I think there's even here it is, yeah, total return. So this will show you a 1-year return, a 3-year return. You can look at it in percentage, right? 5-year return. There's not many stocks that can say they would return 57% over a 5-year period. It's pretty crazy. Actually, 57% over a 10-year period. So that's 57% per year. Think about that for a second. A CD or a savings account, 1 to 3%, right, per year. You're talking 57% per year. It's insane. So anyway, I'll exit out of this, but you guys can look this stuff up later. But again, 6-month chart, we have all of our settings. So let's look back before Corona. Let's see what we got. Okay, not really a buy opportunity there. Do you see something familiar here? Pretty much the same as UPRO, right? Dips down below the 200. We touch oversold. Then, bam. This was before Corona. $59 a share, $60 a share, up to 77. Keeps climbing all the way to $100. Takes a little dip, all the way up to 118 before Corona hits. So think about that for a second. In just a few months, $60 a share. You're talking almost 100% return over, what is that? October, November, December, 3 months, all the way till March. So you're talking about, um, 5 or 6 months, 5 or 6 months, 100% return. I think most people would be pretty damn happy with that, right? And like I said, the chart, here we go. Oversold, oversold. Candle over candle right here. 200 moving average right there. Here we go. Oh, one thing I do want to point out, and this happens a lot with a lot of stocks and a lot of ETFs. So tax season, right? So a lot of people, or a lot of times, the hedge funds, they want to lock in their gains for the year, and they'll start selling off around the end of November, December timeframe. Not always, but sometimes. And you can see that sell off here. They started selling in October. So you see we're right here, we're at 71. Then you start this downtrend, right? Downtrend, 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 all the way up until the end of the year, because they're selling off to take their gains for tax reasons. So that's another good chance to get in when a big sell off like that happens, and then you just ride it back up. So this happens over and over again. You see, and there's a few times here where there's some short gains, some small gains, even in the downtrend. But me personally, when I start seeing a downtrend like this, and the time of year, it's November to December, and I start seeing a downtrend, then I'm not gonna be buying during this time, because I know what the big hedge funds are doing. They're selling for tax reasons. Once that new year hits, right here, then we start the uptrend. Then I'm like, okay, I'll jump back in. Again, this is a new one for me. TQQQ is new for me. I haven't traded it in the past, but the pattern is very easy to see. 58 up to 72, right there, right here. 56 up to 68. Guys, I mean, it might not seem like a lot, but these little gains right here, you're talking, 15 to 20% gains in a month, in 1 month. Most hedge funds, average anywhere between 9 and 12%. You can beat these hedge funds easily. Here's another one. 45 up to 52. Dips back down to the 200. 45 back up to 55. This happens over and over again. Right here, barely touches it. You can just go back and look how many times this pattern happens over and over again. You see this right here, split. So what this means, a split, is it means the stock has, it's went up, it's continued up. So what this means, 2 to 1, is now, let's say you had 100 shares, it splits off, you now have 200 shares. So that's what happens when they want to lower the price and, get more buyers. They do that. But anyway, I'm not going to beat this to death. I just wanted to show you guys why. These are the two ETFs, UPRO and then TQQQ. They're both from ProShares. Easy way, to make some big money. And you're really, all you're waiting for is for it to be oversold, and then you jump in and you ride it out. How long you hold it depends on your style of investing, right? how the market's doing for that year. You know, you can get a 20% return, 100% return. It all depends on how long you want to hold it. I will say, you know, you have to be able to stomach, if you're going to be a really long-term holder, you have to control your emotions and stomach these dips. Because traditionally, so I'm going to show you this real quick, 5-year chart. Traditionally, the stock market always goes up, right? See a big dip there, but continues up. A big dip here. Now look at this. I want to point this out to you. We topped out here in February. We took a huge dip here in March. But by July, so you're talking 4 months later, we're back where we started. Pretty crazy, right? So it's just something to note. Like, I can tell you, panic and fear overtook a lot of people right here. Panic and fear right here. And a lot of people sold as this was coming down. But a few months later, it's right back where it started. So that's probably the hardest part, is to control your emotions, and just trust in your investment, right? Trust in your decision. So the only other thing I wanted to show you guys, if this if this seems too this might seem like too much for you, like, man, it goes up, down, up, down, up, down. It's too much for me to deal with. I don't want to have to watch the stock market every day. There is another option, and this is the S&P 500. It's SPY, but the same thing applies to SPY. The only difference is, with SPY, it pays a dividend. So even when the market's flat, you can still make money off of it. And you're not going to see as many dips like we saw with the other ones. You're not going to see as many chances to buy. But when you do, like right here, see how I touched oversold and the 200. Percentage wise, it's not going up as much as the ETFs. But the ETFs do not pay a dividend. So every one of these D's is telling you it paid a dividend. And for SPY, we'll get out of the full screen just so I can show you guys. Well, it's not letting me out of it for some reason. It's weird. Okay, let's just go back to the page. Man, I really wish this wasn't so slow. All right, here we go. So you guys can see too, this is the SPY. This is financeyahoo.com. What we've been looking at is the charts, but you can see here expense ratio. So this is how much they charge per year for the fund, 0.09%. That's really, really cheap. Management fee, where UPRO and TQQQ, they both have a 0.95%, so almost a 1% management fee. But those funds return a lot more money. But this, again, pays a dividend. So when we talked about CDs and stuff like that earlier, so you have right now, and this fluctuates, it does change, but when you see yield, this is how much it pays for, like, even if the market's flat, you're guaranteed a dividend of 1.85% of whatever amount of money you have invested, right? So even if the market's flat, so this is comparable to like a CD, right? You're going to get that one. If the market goes up, down, sideways, whatever, you get this 1.85% on top of what the ETF actually does. So we've already got our settings. So for example, here during this dip, you get paid a dividend. You stay in. So you're also making money as it goes up, right? You could choose to sell it and take your profits, or you can just hold it and collect the next dividend, and it continues up. So for a person that wants to be a passive investor and not really be too involved, just kind of set it and forget it. Put my money in. I'm going to leave my money in there for 10 years. I'm going to collect the dividends as it goes up. This might be the better route for you because it does have a pretty good return as well. Again, it's not nearly as close. When you're talking TQQQ and UPRO, their annual returns are way more than the SPY. But the flip side of this is when there is a dip, the SPY doesn't dip as much as those others. So it depends on what you can stomach. If you can stomach this, like you see here, 290 down to 240. So let's say I had 100 shares, right? So I got $2,900 worth of stock. Takes a little dip here. Now my 2,900 is 2,400. So that's $500, right? You can stomach that. You can hold through that. Doesn't bother you, right? And you just keep investing, keep putting money in every month. This might be the one for you. But if you can stomach the moves, I'll just show you. So let's see. Show you real quick. So we'll take since coronavirus. We were at roughly 337, dipped down to 228. Pretty big dip. However, TQQQ, because it tries to do 3 times, right? It's trying to do 3 times what the NASDAQ does. Whoops. So it went from 114 down to 44 or 35, sorry. Percentage wise, you do the math. That is a huge drop, right? That's like, what is that? 70 would be 50%, so 35 is, let's see, 70, wait, not 70. 56, whatever, would be a 50% drop. So you're probably talking about like 60-70%. That's a lot. That's a big drop. But if you're the one getting in here, look at the return. You're talking 200%. Easy. That's insane. 200% return in like 6 months, less than 6 months. So again, you have to decide what type of investor you want to be. For me, I'm trying to grow my account, um, as much as possible. Um, but I will, even if I, grow my account, I have a house paid for, that type of stuff. I'll probably continue to trade these just because, looking at the charts, it's very predictable and it's easy. I don't have to go into a bunch of crazy details, and I'm not freaking out if it takes a little dip, um, because I know I'm invested in some of the best companies in the United States. Um, so anyway, guys, that's it for now. Hopefully you guys enjoyed these videos and learned something from them. And then I'm hoping to, in the future, I'll do some videos on actual live trades when I buy into the market, um, for these longer term trades, and show you guys how it plays out. Cool. Have a good day. And again, you guys rewatch these, replay them. You can go back to these, and hopefully, if it helps you out, or if there's something else that you would like to see, let me know. And hopefully, I'm busy. We're all busy, but I'll try to make more of these in the future. All right. Thanks, guys. Have a good one.